Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today, I'm joined by a special guest, Lucas Siegel, founder and CEO of Harbor Life Settlements, a company that helps retirees facilitate life settlements. Lucas, welcome to the show.
Thanks so much for having me.
So Life Settlements offers a unique way to generate funds for individuals who hold life insurance policies. And that's whether you're considering selling your policy to an investor, if you're intrigued by potential returns. I'm hoping or looking forward to today's conversation with you, Lucas, and to really help understand the ins and outs of life settlements. But before we get started, can you just give us some background on what a life settlement is and how it works?
Yeah, absolutely. Just like a house, just like a car, just like a pension or a 401k, life insurance is private property as of a 1911 Supreme Court ruling. It's called Grigsby versus Russell. And what a life settlement is a liquidity option for that asset that is that family's. So just like you could go and sell your house or sell your car or sell stocks that were your stocks, you can sell your life insurance policy. And it's a liquid asset and you have every legal right to do it. So life settlement is basically, let's say you're 80 years old, you've got $1 million life insurance policy. You've got a couple options. You can continue to pay premiums, pay the amount that it takes to keep that policy in force every month, or you can surrender it back to the life insurance company and get your cash out of it, some of your cash out of it. The third option is you can sell that policy, many times for way more than you could ever surrender it for. In that case scenario, let's say you're 80 years old, you've got $1 million policy. Once again, you might be able to sell it for $500,000 cash today, and you never have to pay a premium again in your life. The sale of that means that when you pass, let's say 4, 5, 6, 7, 10, 15 years from now, the private equity fund, hedge fund, bank, institutional investor that purchased that policy from you would get that $1 million. But they would also be responsible for the continuation of payments for as long as you live that you are now off the hook for. Life settlement is selling your life insurance policy that you no longer need, want, or can carry forward to a third-party investor that wants to buy it.
Now, I know when you surrender a policy, right, you're taking whatever that cash value is out and you're done with it. Is it the same on a settlement where I don't have to worry about anything else with this policy? They're paying the premiums, or there's no give back where something happened and now all of a sudden I re-own this policy again? Is it the same concept where once I have a settlement, I'm done with it?
Yeah, so you're really looking for a gotcha clause with the sale. And no, there isn't a gotcha clause with the sale. And the docs are you have to sign the docs right when it happens. But there can be a situation where if there's something called a retained death benefit, so if you only wanted to sell 50% of the policy, things can get a little sticky because you're not just selling it and walking away from it. But I would say 95% of all life settlement transactions are pretty cut and dry, which is I'm selling you the future potential death benefit of my policy, and you're going to give me cash today for it.
Are there standards with the settlement, meaning I'm going to get a lump sum, or is it negotiated on how the payment is paid, or is there standards and says, no, if you do a settlement, you're getting a lump sum and that's it?
So we negotiate for clients all the time, but I would say pretty much 100% of the time it's a lump sum. It's in the best interest for the family, and it's just the cleanest way to do the transaction is a one-time lump sum of cash.
And what's the tax ramification of doing a settlement?
Yeah, great question. So you've got the amount that you've paid into the policy throughout the life of the policy. That's called a cost basis. So let's say you've paid in $400,000. We're not tax professionals. I'm not giving official tax advice. Disclaimer. But I'm going to give you a very basic overview of how it's taxed. So let's say it's that $1 million policy on the 80-year-old. Let's say that they have paid $400,000 into the policy throughout the life of the policy. And let's say hypothetically they got a $350,000 offer. They're going to pay $0 in taxes because the amount they get is less than the amount that they've put in throughout the life of the policy. Now, same situation, different scenario. $1 million policy, they've paid in $400,000 into the policy. Let's say they get $500,000 offer. Under that scenario, that $100,000 differential between the amount they got for the offer and the amount they've paid in is going to be long-term capital gains. The $400,000 that is up to what they put in is tax-free. Now, there's different simulations and permutations of this, where if your cash value is greater than the amount you've put in, there can be some ordinary income, but I pretty much never see it. The most simple, real version of how to explain this in a way that does not get super confusing is that if you're getting more than you paid in, the difference is going to be long-term capital gains. If you're not getting more than you've paid in throughout the life of the policy, it's tax-free.
Okay, pretty simple, straightforward way to look at it. How are these policies valued? Is the investor actually doing underwriting where they're looking at the health of someone, or is it kind of, all right, this person is this old, this is what the policy looks like in terms of the makeup, and therefore there's a computation that creates the value from it?
So, yes, there's a ton of underwriting. There's so much underwriting, which is why people use us and financial professionals use us to do the underwriting for them, because it can get very complicated. And there's different permutations of a life settlement. I'm going to just go with the most standard permutation of a life settlement. And that is, we go get the medical records on the insured, and we get a third-party actuarial firm to do a life expectancy analysis. That analysis says how long they're going to live. And it's always wrong. Our job, strangely enough, is to try and find the shortest life expectancy analysis we can. So we know all the big life expectancy players, and because we represent the families, because we are fiduciaries, and because we typically work with advisors, and this is going to sound very strange, but we want to make their health look as bad as possible, because that means that the investor is going to pay more for the policy and it's going to net more for the families. So that analytic is done. We hire a third-party actuarial firm. It's almost like an appraisal of a house where you get a third party to do it. Then we do underwriting, where we correlate. If you look at how is a life settlement priced in the most basic of views, you've got the death benefit on one side, and then you've got how much is the premium per month, and then how many months is that hedge fund, private equity fund investor going to have to pay until the person passes and they get that death benefit. Then they stick a net present value on it, looking at a discount rate.
Then what happens next? Is there a market? I know if I sell the policy, it's easy. I can go back to the insurance company, surrender it. But what about on a settlement? Is there a readily available market?
So before us, not really. That's kind of the point of our whole company. I used to work on the buy side of settlements for hedge fund, and there was no centralized, standardized marketplace. So what we've basically built is pretty much the MLS. You know, if you're familiar with MLS for selling a house, where you can list it on MLS and all these people see it, we've built the MLS for life settlements. So we underwrite the policies. We do all the work to figure out what we think it's worth. And then we've built an online HIPAA-compliant certified exchange. And what that exchange has is almost every single institutional investor in the world that buys these things all in one place, bidding against each other to drive up the price. And what that's done is made the auctions, we call it an auction, for these policies way more competitive. Because instead of going to one or two or three people, you're getting the entire market fighting for the policy, which drives up the price and is good for the consumer and good for the advisor. Additionally, with a lot of advisors, you know, if they're fiduciaries, they need an auditable fiduciary track to show that what they did was the right thing for the consumer. And our auction gives not only bid history, but bid history by the second to show what the auction did, what the price was, and that it was the best price they could have gotten in the market.
And you mentioned the institutional buyers, or I guess could individual investors come on the platform as well if they wanted to purchase life settlements?
Not really. It's mainly institutional. Now, if an individual wants to buy it, we typically send them to some of our institutional intermediaries to vet them, and then they work with the institutional intermediary. But we're dealing with highly sensitive information. This is people's health. And so we don't let any Joe Schmo on the platform. We'll point them in the right direction to say, hey, if you want to go with a credible, institutionally vetted source, they can be an aggregator for you, but not an everyday investor can hop on the platform. And the other thing is, these things are freaking complicated. It would be hard for some unfamiliar investor to this asset class to just go buy policies, because you wouldn't even know what you were looking at. That's how complicated these things are, and looking at the cash flows. So that's why some of these intermediaries are really good for kind of like putting it all in layman's terms about what the case looks like. Our job is to represent the financial advisors and the insureds, not to represent the investors.
Makes sense. So after, let's say, the auction happens, bid is reached, what kind of finalizes this? Is it just paperwork, contracts?
Yeah, so our auction, it's funny. We've built something called an anti-sniping clause. So these are timed, and it's got a countdown timer of like when the auction's going to end. And we've found that investors in the very beginning were trying to bid in the last like 30 seconds to try and get a better offer. So we built an anti-sniping clause in our platform, which says that if anyone bids in the last 30 minutes of an auction, it automatically extends an additional 30 minutes and notifies all the people who bid on it. So eventually, when the auction ends, we've had to extend like 15 times, which is really fun to watch and really good for the consumers. But once it ends, we build an offer letter that shows all the bids that they got, bid history down to the second, runs some numbers, it runs analysis, because what a lot of people want and what a lot of financial advisors want is, should they keep it? Should they sell it? Should they surrender it? Just break it down. What should they do? So we run math. We show an auditable trail of how the bids were, and we come up with an offer letter. That's then presented to the advisor and the family, who then has a choice to make. If they choose to accept it, we notify the fund, and we work with the buyer to work in contracting. So we prep all of the contracts, stick it notes in there to show who needs to sign where, and then FedEx it to the family. The family signs it, sends it back to us. We review it. If there's anything missing, we send those things back. If not, we send it straight to the fund, and then the fund's legal team reviews it. At that point, they fund escrow, and we put into the life insurance company a change of beneficiary and a change of ownership. Once that's been confirmed by the life insurance company, escrow is released and the family is paid. Now there's typically a 15-day rescission period, which means after the family's paid, they got $500,000 in the bank. If someone gets COVID, not that people are getting COVID anymore, which happened, but if someone gets sick and they've already been paid, but they're within the rescission period and they're like, no, I want to back out of this, they can do that in that rescission period and make the sale not happen. But after that rescission period ends, then it's over. That was probably a very long answer.
Does the rescission, is it on both sides, or is it just on the seller that has to?
It's just on the seller.
So you talk a lot about health and how that factors the price. What else factors it? Like interest rates, or is there other things that go into how these things are valued?
Yeah. So loans on the policy, we've got a whole nother program that is all loan refinancing. That's probably 40% of our business, because interest rates have gone up so much that loans are getting egregious and people need something to do with them. So loans are part of it. Health is the biggest part of it. The other thing we call it the premium to face ratio, which is how much does it cost in insurance premiums every year as a percentage of the death benefit. So if it's like a 2% premium to face ratio, it's a good policy, because the higher the premiums required every year, the lower the value the policy has in a net present value perspective. Those are the main things.
Does the type of life insurance policy matter? If it's a whole life or a universal or a variable, does that come into play as well?
Yes. So universal life, convertible terms, great. Variable life, which is many times a form of universal life. IUL, which is a form of universal life. SUL, survivorship, form of universal life. Those work awesome. Whole life does not work very well for a traditional settlement. Although we do whole life deals, it's harder on a traditional settlement perspective. But we have a lending program that works as a life settlement very well with whole life policies, where people can get all their cash out of their whole life policy and keep a residual death benefit and never have to pay a premium again.
Is there like a sweet spot where it really makes sense for the person to sell it, even if it's just from like an age or something specific about the policy? And I know we talked about these as retirees or people getting older. Can anyone sell a policy, or is this like a reverse mortgage where you have to be over a certain age and there are certain like regulations on who can sell and who can't sell?
Typically, if I'm just going to give the truncated idea of who can and who can't sell, you got to be over the age of 75 with a policy over 100,000, or you've got to be sick. Now, for the loan program, it doesn't matter what your age is.
You mentioned the person who's sick, and I'm not sure if you were talking about just like some kind of sickness, or a terminal sickness where it would fall under maybe like a viatical settlement. What's different about that and how they're priced and kind of the whole flow of it versus just a regular life settlement?
When I say sick, I mean 15 years or less life expectancy. Viatical settlement typically refers to 2 years or less, and those are worth a ton of money. The investors only got to wait a couple of years until they get the death benefit. But one of the things we do as a service for free is if someone comes to us for a viatical, we always read through their contract with the insurance company, because a lot of insurance companies have terminal illness riders in the fine text of the contract, which allows the family to get a bunch of the money out while they're sick. And so many times we'll go run the math and we'll be like, hey, we know that you said you wanted to sell it, but we actually think you should do this.
I mean, we started this off by saying you have a person has a couple of options, right? They can keep it, pay the premiums, take the cash out, surrender it, or look at a settlement. You also mentioned how these things are priced by you taking present value, discounting it. Is that how someone should do a comparison on which of these options is the best? They take the value that a company like yours would put on it and then look at, well, if I did surrender it, I would have this much, and with that much, I could have some gains as, or a return of X on that, and then somehow try to make this an apples to apples comparison, or is there even a way to make it an apples to apples comparison?
Yeah, that's exactly what we do for people. We look at if you sold it, because it's not just about selling it versus the death benefit, because the death benefit's in the future. And so you've got to discount for the time cost of money. So what we do is if you sold it, got $500,000 today, what are you going to do with the money? And they say, oh, well, I'm going to go on a cruise. I'm like, okay, well, that's $30,000. What else are you going to do with it? And they're like, oh, I guess I'd invest it. Okay. What investment, Mr. Advisor, do you think you can get? What kind of rate? So we put in that $500,000 earning 8%, 10%, 6%, whatever they're feeling over the life of the insured via the life expectancy. And so that interest compounds on itself versus, okay, if you surrendered it, what are you going to do? Let's say you had $300,000 in cash surrender value. What are you going to do with it? Okay, same thing. We're going to go invest it. Okay, we put that in compounding, and then keeping it. Okay, we're going to keep it. Okay, great. Well, you're going to live 12 more years, and you're going to have to invest money into this policy every single month for 12 years. So we're going to do that for you in the calculation. And so that is wearing down that value, because if you would have invested that money that you're paying into the policy, that would have gotten interest rate. And so we just line it all out to make it just like very clear of like, yeah, we should do this.
Yeah, makes sense. You mentioned that you guys were the first to really create this marketplace for settlements. How did you get into this space?
Yeah, I mean, I worked on the fund side for the people that were buying these policies, these big institutions that are buying these policies, and the market was so bifurcated. It was insane. You'd get calls from people in Florida just kind of like wheeling and dealing. Hey, I got a policy. What are you thinking about? And a lot of backdoor deals going on in the industry. It was just not, for such a institutional asset class, it felt a little Wild West. So my vision was like, I see how chaotic this is on the buy side. Instead of just being on the buy side and continuing to do what I'm doing, why don't we go fix this? Why don't we go fix this so that we can help more people? So that's what we did. We centralized the buyers into one individual place and made it auditable.
And I know you mentioned the Wild West. At that same point that you were coming in and kind of building a market, what has the, I guess, regulations look like in that same time period? I guess they'd want to put on some protections from the seller, but obviously there's things on probably the buy side as well that come into play.
The regulations to me are shocking because your initial reaction was that they put in a bunch of protections for the seller. And yes, they did, kind of. One of the things that the regulations say is that you have to have a provider in a transaction. Think of a provider like on a real estate transaction. You've got the broker that represents the person selling and a broker that represents the person buying. You know, you got two realtors on either side looking at each other. The provider represents the fund, not the consumer. Yet the regulation that was passed says that you have to have the person representing the fund and the buyer, not you have to have an entity protecting the insured. It seems reverse. It seems really stupid. And then you got to think about, well, who paid the lobbyists to pass that law? The funds. So it's even more important today than it ever was to have us or someone like us, which is a licensed broker who is legally obligated to represent the person selling, not the person buying, and not pretending to represent the person selling while representing the person buying. But there have been other regulations that have been passed that have been good. So like one of them is disclosure and making sure that people like us have to disclose compensation. And then, you know, just kind of trying regulatory matters, trying to make things more concrete and less Wild West. And there's been a lot. And I would say 90% of the shenanigans in the market that were happening in the 80s and the 90s are gone. And it's really becoming more uniform. But we really think that the industry needs to regulate itself because the government takes too long. They're too slow. They're just generally bad at whatever they do. So we're coming in here as trying to be, you know, really being an industry leader and saying like, hey guys, let's do this right. Let's do this in a way that makes the industry proud and the way that the industry in 10 years would look at us and be like, yeah, they knew what they were doing.
What do you see as far as like trends or what's going to happen next in the industry?
I think life insurance companies are getting more involved and will get way more involved in the transaction. It's a way for them to buy market share from each other. Like if they buy a bunch of New York Life policies, then Lincoln kind of owns a piece of New York Life. It's also a way for them to hedge their bet to make sure that they're getting some of the upside when someone passes outside of just the downside. And more capital is going to enter the space. More technology is going to continue to disrupt it. And this is something that should really be just a household name thing. Like when a financial advisor is doing an annual review of their clients' assets, many of them are just putting the cash value of the policy in that review, which a life settlement is typically 4 to 12 times that cash value. So it's irregular reporting that almost every single financial advisor in the country is doing because they're not showing the true value of an asset. I pray that is going to change, because a lot of families are making financial decisions with incomplete information.
You mentioned technology. Do you ever see it getting to like a way Fundrise created this marketplace where the retail investor could go and have an interest in this type of asset class?
Possibly. I would say it would be a while, because just regulation on this asset class is pretty high and there's a lot of eyeballs looking at it. But one thing that I can definitely say is coming is smart contracts using the blockchain, because these contracts are horrendous. They're so long. It takes 1 million signatures. They take forever.
Are you talking the policy or the actual settlement contract?
The actual settlement. 100% is going to get turned into smart contracts. The other thing is, like, biggest unknown in this business from an investor perspective is longevity. Is the life expectancy right or not? And that's where all these funds have gotten, if any fund that lost in the space because of longevity. And with all this genetics and genomics science going on and blood testing going on, and layered in with tons and tons and tons of data on human mortality and American mortality, along with EMRs, electronic medical records coding, I think that we're going to start seeing AI that can look at data points and triangulate a personalized mortality curve, which can do personalized life expectancies almost instantly.
Yeah, it would seem like it would have to be, because it's like almost like a race. You have the data and how well you can analyze it, but also the medicine improvements and things like that are constantly going up as well. And it's kind of a race to figure out, like you said, how to be as accurate as possible. And you got two competing areas, so it definitely should be interesting.
Yeah, and you've got aging population where the average number of people turning 82 per day is going to double. And medical costs and long-term care costs are growing at an inflationary, insane rate. And so you've got all these people with this asset that they didn't know that they had, that need liquidity to care for themselves in the future. I think the space is going to grow tremendously.
Yeah. Well, Lucas, we're just about out of time. I want to thank you for being on the show today. You provided great info on how everyone can get the most out of their life insurance policies through a life settlement. How best can someone reach out to you, find out more about what you and Harbor Life Settlements does?
I would email hello@harborlifebrokerage.com and just reach out to our team. That goes to our whole team. We're really excited to work with people and work with teams and see how many people we can help as quickly as possible. So thank you guys so much.
Thank you. And we'll link to that in the show notes. And thank you everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.